welcome you to today's web conference titled FINRA's Examination Findings and Priorities, a look back and what to expect in 2018. Today's presenters are Foley Securities Litigation and Enforcement Partners Allison Charney, Joe Edmondson, and Dean Jeske. Allison, Joe, and Dean focus on defending securities litigation brought by private clients and financial industry participants, as well as enforcement investigations brought by the SEC, state regulators, FINRA, and other self-regulatory organizations. Of particular note, prior to joining private practice, Dean was the Deputy Regional Chief Counsel in FINRA's Department of Enforcement. In that role, he supervised significant enforcement actions in FINRA's Midwest region and spearheaded nationwide investigations in litigation. Before I turn today's presentation over to our speakers, I would like to go over a few housekeeping items. Today's program will last approximately 1 hour, followed by a short question and answer session. We encourage you to submit written questions during the program. Please type your question into the Q&A widget open on your screen. We will respond to written questions at the end of the program, time permitting. The webcast console you are looking at can be completely customized. You can resize or move any of the windows that you have open, including maximizing the slides on your screen. If you experience technical difficulties during the presentation, please visit the webcast help guide by clicking on the help widget below the presentation window. The presentation and on-demand recording will be available on Foley.com within the next few days, or you can get a copy of the slides, the outline, and the attorney affirmation form in the resource list widget. And now I'd like to turn our presentation over to Dean Jeske.
Thank you, Kayla. Good morning, everyone. And I guess for those on the East Coast, good afternoon. This is Dean. Allison and Joe and I are all thrilled that you were able to join us. And hopefully you'll enjoy the presentation and take something away from it. As Kayla mentioned, if you do have questions while we're presenting, feel free to type them into the widget. We're going to wait to answer questions until the end. Hopefully we'll have a few minutes at the end to answer questions. If we aren't able to get to your question, we'll endeavor as best we can to respond to you directly. The other thing I wanted to mention is we have prepared a more detailed outline beyond the PowerPoint that you're going to see today. And you'll be receiving, I think, a copy of that in a follow-up email after the presentation. So with that, let's get started. I thought I would start with first sort of walking through quickly what we intend to cover in our presentation. The first thing I'll say is we're obviously going to be talking about the 2018 FINRA Examination Priorities Letter, which came out a couple of weeks ago. FINRA has also provided all of you and us with another tool to help think about and predict what might be coming in your exams this coming year. That's the 2017 Examination Findings, which came out for the first time ever this past December. So what we're planning to do is not really discuss them separately, but really kind of look at them collectively, and to the extent that there's helpful guidance or information from the examination findings document that bears on issues that FINRA is identifying as priorities for 2018, we're going to try to combine those together. I'll tell you up front that we're not going to touch on every single topic that's mentioned in the priorities letter this year. We just didn't think it was worth your time for us to let you know that AML is a priority for FINRA, because it's been a priority in every letter they've issued that I can think of. It's going to be a priority this year, and it'll be a priority next year. So what we've tried to do is go through the letter and be a little bit more nuanced and pick out those topics and areas that we thought were either new or that there was something interesting about them. And so that's what we're going to focus the presentation on. The way we've divided it up, I'm going to focus the first few minutes on sales practice related issues. I'm going to go through them somewhat quickly because I was told when we did this same presentation last year that I talked too much. So I'm going to try and give my colleagues a little bit more time than I did last year. So I'll cover sales practice issues. Allison and Joe are then going to focus on issues relating to market integrity and operational risk, those types of issues. Before I actually get into the sales practice issues, I'm also going to spend just a couple minutes talking about kind of what I saw last year from FINRA, particularly in the enforcement context, because last year was a bit of an unusual year, at least from my perspective. And I've had some discussions with some of my former colleagues at FINRA, and they've kind of confirmed my sense of last year. So that's kind of what we're going to cover. But before we do that, we have sort of a new element to our presentation this year. We're going to have a FINRA trivia question that I'm going to give you all right now. And whoever answers that trivia question first is going to win some really valuable fun prizes. And you can answer the question by simply typing the answer in to that Q&A widget. And again, whoever the first correct answer we get will win some prizes. And I'll sort of let you all know about that when we get to the end of the presentation. So here's the question, and it's sort of in honor of the fact that 2017 was actually the 10th anniversary of the combination of the former NASD and the former NYSE regulation. And obviously the name of that entity is FINRA. But as it happens, the original name that was given to that entity was not FINRA. They actually gave it a different name upon the merger. And that name lasted for about 3 weeks and then was replaced by FINRA. So the question is, what was that original name that they gave to what is now the combined NASD and legacy New York Stock Exchange regulation, FINRA? And I'll give you bonus points if you can tell me why they sacked the original name and went to FINRA. All right, with that, let's get started. So last year was an interesting year for FINRA, and particularly in the enforcement context. There were a lot of changes, and from my perspective, and like I said, I've confirmed this with some of my colleagues who are still at FINRA in the enforcement area. It felt to me like there was a bit of a pause last year, and that was a direct result of this FINRA 360 initiative, which I suspect most of you at least have heard of. You may not know exactly what it is or all the details of it, but it's an initiative that was really the outgrowth of Robert Cook, the relatively new president and CEO of FINRA, of his sort of traveling around the country and meeting with member firms and their representatives and going on what he called a listening tour. And an outgrowth of that was this FINRA 360 initiative, where FINRA really decided to do kind of a top-to-bottom review of all of its operations. And last year, much of the focus was in the enforcement area. The biggest development, at least from my perspective, in the past year that grew out of that FINRA 360 initiative was their announcement in June that they were merging the enforcement department and market reg legal department. Now, many people I've talked to in the industry, clients and colleagues, weren't necessarily really aware that there were two different groups within FINRA that engaged in enforcement activities and brought enforcement and disciplinary actions. There were, at least as of last year. And this was actually a pretty big development for FINRA. It's certainly a big development internally because the two departments really did function very autonomously. They had different reporting structures. They oftentimes had different procedures as to how they approached investigations and the bringing of disciplinary actions. And so the combination of essentially merging the market reg legal team into the enforcement department is I think, a fairly big development. And so you may be thinking, okay, that's fine, but why does this matter to me? Here's why I think it matters to you. I should advance the slide, shouldn't I? No. Here's why I think it matters to you. The reality is that, like I said, the way the more traditional and larger enforcement department that many of you are familiar with functioned and the way it conducted its business oftentimes was different than the way the folks in Market Reg Legal conducted themselves. And so this is going to be, the combination is going to bring a lot of uniformity and consistency, I think, to the way that FINRA enforcement now interacts with its constituencies, including its member firms and registered representatives. Just to give you an example, it was not uncommon in the Market Reg Legal context when you were interacting with a Market Reg Legal lawyer for them to call you up after an exam had occurred, wells you on the phone the first time they talk to you, and then immediately send you a letter reflecting the wells and a draft of an AWC, and essentially expect you to kind of sign it and just pay the fine. There was a bit more of and this is my view, by the way, I'm not trying to be critical of them, but there was a bit more of an assembly line approach to enforcement in the Market Reg Legal group, which could be frustrating at times. They oftentimes weren't as familiar with the underlying facts and the back and forth that the firm may have had with the examination staff in the Market Reg group, as you would find in the enforcement department. So I think for those kinds of reasons, that this really is a big development. I think it's something that inures to the benefit of all the member firms, all of you and the folks within your firms that interact with the enforcement department. As I said, I think because of that announcement and then the ultimate process of integration, which is ongoing, by the way, they're not done integrating Market Reg Legal into enforcement. But as a result of that, there were a lot of resources essentially pulled away from the active investigations and the cases, the disciplinary proceedings. And so it felt to me, at least anecdotally, like cases were kind of lingering around longer, and you would go longer stretches of time between when you heard from whoever your contact was in the enforcement department. Clearly, FINRA brought substantially fewer cases in 2017, and I think that's at least in large part due to this integration effort and the amount of resources that were absorbed by that. But here's what I think is going to happen now. I think that sort of break, that pause in the action, is over now, and I would expect that FINRA and FINRA enforcement in particular is going to be very, very active in 2018. So for those of you that have matters out there where you were dealing with enforcement, and maybe you haven't heard from them in a while, I would suggest to you that it's likely that those cases haven't gone away, that they've just gone dormant, but they're going to come back to life, I would think, in the first quarter of this year, unfortunately. So that's really what I thought the biggest development was from the past year, and kind of what I'm expecting from an enforcement perspective this year. I've listed a few other sort of FINRA 360 developments. One of them is the exam findings report that they issued in 2017. I think that's a very good development for all of you. At the end of the priorities letter, there's a list of 2 or 3 new report cards that FINRA is going to be issuing in 2018. And again, I think those are an outgrowth of this FINRA 360 initiative. And so you can take a look at those, and to the extent that any of those report cards are relevant to your business, I suspect when and if the FINRA examiners come in to do an exam of your firm, one of the things they're going to look for is how are you incorporating those new report cards into your supervision and your surveillance of that particular business. So to the extent that they're relevant to you, I would suggest to you that you focus on identifying those report cards and how it is you can incorporate them into your already existing supervision and surveillance procedures. Robert Cook has made it clear that one of the things that he heard about in his listening tour was increased transparency. I think FINRA is making some strides in that area. They just recently issued their budget summary, which they are doing for the first time, and some guiding financial principles in that budget summary that you can find on the FINRA website. There's increased transparency, or at least an attempt to provide increased transparency into the FINRA committee structure and who's on those committees and the process for applying to be on those committees. In terms of what's next in 2018, the one thing I believe is going to happen, and this was confirmed by a little video interview that's on the FINRA website, and FINRA on its website has a FINRA 360 page that you can go to kind of see what they're doing and the result of the FINRA 360 initiative. In any event, there was a video interview of Mr. Cook towards the end of last year where they asked him about where this FINRA 360 initiative may be heading. And one of the things he said was that much like the introspective look that they took at the enforcement area, they were going to do that same kind of introspective look into their examination program. And so I don't know for sure, but I suspect there may be an effort to integrate or consolidate some of those functions within the examination program. And we'll have to kind of wait and see how that plays out. But again, I think that would be a positive development for all of you, so that there's more consistency, less overlap. Hopefully, you're hearing from the examiners less often, and when you do hear from them, it's more consistent. Okay, with that, let's turn to some actual priorities. So I don't think anybody is surprised that FINRA thinks fraud is a priority. I didn't put that on the PowerPoint presentation because I thought that was new or particularly surprising. Instead, there were a couple items that were mentioned in that section, which is the first section in the letter, that I thought were of note, so I wanted to touch on them quickly. FINRA, for a number of years, has made it a priority to focus on microcap fraud. So again, that's not new. They're particularly focused on microcap fraud in the senior investor area. What I found interesting this year was there's a paragraph at the end of that section in which FINRA recommends that firms be attentive to their brokers' activity in microcap stocks. And in particular, there's a reference to FINRA focusing on their own brokers' trading in microcap stocks. And when I see something like that that is that specific, what it says to me is, okay, they've seen this, and in fact, they probably have a case or two out there that they're investigating, or maybe that they've finished the investigation and they're about to bring a disciplinary action or issue a settlement in that area. And so as I read that, it occurred to me that I hopefully, for those firms on the call that this is relevant to, you likely have pretty good procedures for monitoring penny stock trading activity in your customers' accounts and looking for unusual patterns or things that might be red flags. But question whether you have procedures and processes in place for the trading that's actually being done by your own brokers. And I've sort of heard anecdotally that there are some inquiries out there by FINRA looking at not trading by customers, but trading by the brokers themselves, where the brokers are interacting with stock promoters, essentially. And so I think FINRA is going to be looking at firms and asking, do you have procedures surrounding your own financial advisors and their direct interactions with stock promoter types who are promoting penny stocks? And do you have do you surveil for that when you are reviewing their personal trading activity? Because that's one of the ways that FINRA can act as a gatekeeper in the microcap fraud area. So I thought that was noteworthy. Also in this fraud section, one thing I noted generally about the letter was, unlike the last couple of years, there wasn't a discrete section discussing senior investors. I think that's in large measure due to the fact that Susan Axelrod is no longer there. That was certainly one of her high-profile issues. But they did mention senior investors in the fraud section, and in particular mention the fact that there are these new rules. So I wanted to just touch on those quickly because I'm already seeing that I'm talking too much. this is very timely because these new rules, new Rule 2165 and the amendments to Rule 4512 become effective on Monday. So hopefully you've all thought about those and are prepared for those. These are rules that I think provide some nice tools for firms to address issues of potential manipulation or exploitation of seniors. So that's clearly something that FINRA is going to be looking at as they come in to do their examinations. I'm not going to go into detail about those rules because there's been a lot of press about them. But again, that's something that I think is going to be a priority in the examination process. With respect to high-risk brokers, again, that's not a new topic. That's something FINRA's been focused on for a couple of years at least. That's an area where they're very very concerned about it, because anytime a broker does something bad and they have a history, there's going to be an article written somewhere about it, critical of FINRA. The two issues that I wanted to flag in there are the issue of heightened supervision, and in particular, again, what I've heard anecdotally is that FINRA is concerned that when a firm identifies a broker as someone who's got an issue or has had issues in the past, that they're creating a heightened supervision plan for that financial advisor. But the particular concern is that heightened supervision plan oftentimes isn't tailored to the specific conduct that's in question, or the potentially violative conduct that's in that representative's past. So that's something you really ought to think about. Another issue that's out there is how those heightened supervision plans are being implemented in a situation where the subject of the heightened supervision plan, the registered representative, is in a branch office away from wherever their direct supervisor is. And so I suspect it's FINRA's view that if that's the case, the supervisor ought to be making more frequent visits in person to that office to implement that heightened supervision plan. So I think that's something FINRA will be looking at in their examinations in the coming year. Again, there was a line in this section about high-risk brokers that sort of jumped out at me because it was oddly specific. And again, it struck me as something that they must have a case or two in their pipeline where they've seen this, and therefore they're now going to look at other firms to see if it exists. And that's situations where registered reps are appointed as a trustee or given a power of attorney over a customer account, or potentially even an account that's not a customer of the firm. So I would commend to all of you to look at your policies in that area surrounding that topic. I know many firms just don't allow it at all, and that's great. If you do allow it, whether you allow it or not, what I would suggest, because FINRA has flagged this specifically, is that you consider sending out perhaps a compliance bulletin or a compliance alert or whatever your firm calls them, in the next few weeks, just reminding your registered representatives what your policy is with respect to them acting as a trustee or being given a power of attorney over assets of a customer or outside the firm. You might want to consider adding some search terms to your email search lexicon, the word trustee or DOA, things like that, so you can let FINRA know that you're actively, surveilling for that type of activity. Go to the next slide. Before I turn things over to Allison, I just wanted to run through, again, very quickly, a couple of other things. This is in the suitability context. Vetting of products, new products, is something that FINRA has identified as a priority for the coming year. Again, I don't think that's particularly new. I think what's important and what they're going to look at is, does your firm have a defined process for vetting new products, and do you document that process? But the particular issue that I've heard a little bit of discussion about in some discussions I've had with other counsel and clients is the scenario where you might have a reasonably robust process for vetting new products, but what do you do when you bring on board a group of new financial advisors? or you merge with a smaller shop. And are you going back and as part of your due diligence in bringing those folks on board, are you identifying products that they may be selling to their customers that aren't products that your firm currently has either vetted or has on their platform? And so that's another issue that I think that they're going to be looking at. And that's an area where and this falls under the heading of preaching to the choir here, but that's an area where it's just so important that the folks in compliance can have a seat at the table in connection with whatever due diligence is being done when you're bringing on board a new financial advisor or a group or potentially merging with a firm. So that you can identify those types of issues. They sell these products and we've never sold those before, so we need to vet those products. We potentially need to develop some training for other reps about those and even for the reps that we're bringing on board. There are a few specific issues that I wanted to just highlight quickly, and then I'll turn things over to Allison, I promise. UIT rollovers, again, that was in the priorities letters last year. There's some discussion of that in the exam findings that I would commend to you all to take a look at. The primary focus of what I think FINRA has been looking at and will continue to be looking at in that area is short-term trading and early rollovers of UITs, and in particular, whether firms have an adequate surveillance system for identifying patterns of early rollovers within the UIT product. So that's something we're going to continue to look at. The area of fees and expenses has been something that FINRA has focused on for the last several years in a variety of different product areas. I believe the reason that's the case is because they view it as a bit of a layup for them. So they started with the mutual fund fee waiver cases involving charitable accounts and 401k type accounts, sponsored accounts, where they were entitled to get A shares at NAV, but were not being given those. And it evolved into looking at variable annuity L shares with long-term riders. There have been a series of cases in that space over the last year or so. There's more in the pipeline, and I think that's something they're going to continue to look at as they examine firms in 2018. 529 plan C shares, there are cases in the pipeline that likely will be issued in 2018. But again, I think that's an issue that they're going to continue to focus on with firms. So if you haven't addressed those kind of issues, if you haven't looked at the product offerings and identified those products where they can be sold in different share classes or with different cost or expense structures, again, I would commend you to do that because those same issues seem to keep cropping up across different products. And then finally, and I'll move on, there was a reference in the 2018 priorities letter to securities-backed lines of credit. What I found interesting was those were referenced both in the 2015 and 2016 priorities letter, but then they went away last year, and now they're back. So presumably there's a reason they're now back. They're interested in those again. To the extent your firm is engaged in that type of activity, I think the focus is going to be on disclosing risk so that customers really understand, I've borrowed money and I've used some of my securities as assets. If there are interest rate changes or a market downturn, what does that mean for me, or what potentially could that mean for me? So that's sort of the end of my piece. I'm going to turn things over to Allison now to talk about something much more interesting, which is cryptocurrency and ICOs. So Allison, it's all you.
Thanks, Dean. So I'm going to address, first topic is ICOs and cryptocurrencies, as Dean mentioned. I wanted to give you guys a brief overview of ICOs. It's a really interesting area to me. I'm heading up our firm's initiative in this area. So I thought it would be helpful. We could spend hours on this topic, but let me just give you some context, and then I can go into where FINRA is going, in this area. Many of you know what an IPO is, which is when investors buy stock, which then translate into ownership interest in a company. But in an ICO, or an initial coin offering, what's happening is they're buying cryptocurrency tokens like Bitcoin, and that these tokens are being made by and for a specific company. And so what are these tokens? I've listed some examples here, but they generally fall into two categories. And I recently heard a good analogy that I think helps put some context into what's going on here, where if you think of an arcade, where you buy gameplay tokens to play at an arcade, for those of us that remember what an arcade is. And there's a type of token called a utility token, where you are exchanging, the token is used in exchange for goods or services that the crypto company is going to offer. And that's actually an arcade analogy. It's when you buy the gameplay tokens at the arcade, and they're meant for that specific arcade and nowhere else. And then there's another type of token, which is a security token. It doesn't mean that it's any safer or more secure than a utility token. But what's happening in that situation is you're buying into the crypto company the way you would in an IPO, instead you're not getting any equity. The idea is that once the company comes up with a use for the tokens, they're going to be worth more, and demand hopefully would be high. And so as an early investor, you can sell these tokens for a profit. And going back to the arcade example, let's say somebody's going to open an arcade in the future, and you buy these arcade tokens up front. There's only going to be a limited number in circulation, you're told, and you believe once the arcade opens, they're going to be worth something. And so that's kind of, in very simple terms, what we're dealing with. The next slide. So where does that, where are we from a regulatory standpoint? Before I actually get to what FINRA thinks, it's important to know what's going on with the SEC and the CFTC. For the most part, we are seeing we're seeing lots of statements and roundtables where the regulators are aware of the issue, they're looking at it. There's no real clear guidance. There's a lot of gray areas. We're seeing just the last week alone, I think there was 3 or 4 cases coming out of the CFTC. The cases tend to be traditional fraud cases. It doesn't even really matter that cryptocurrency is at an issue. They're Ponzi schemes or traditional fraud matters, but that issue are these cryptocurrencies. The SEC has brought a handful of similar cases, and so the question now is, where does that leave legitimate players that want to be in the market, who are not out there to perpetuate a fraud? And again, like I said, there's no real clear guidance. It seems that the SEC is leaning towards treating every ICO as a security, and if you're not registered, it would be shut down, where the CFTC may have a little more leeway and be more open to innovation. The other question is, who's going to be the primary regulator? Another gray area. Neither the CFTC or SEC has challenged each other's jurisdiction. In fact, last week, both chairs wrote an op-ed in the Wall Street Journal together, addressing the topic. We know there's lots of working groups, cross agencies. So it does seem like there's a real effort to get a handle on the technology that's moving rapidly. And so with setting that scenario up, where's FINRA coming into all this? It seems like they are, for the first time, we saw in the priorities letter, there's a statement at the beginning of the letter and then a section about ICOs and cryptocurrencies. The general consensus is we're watching, we're monitoring, we may review if we see any issues among member firms, but for now they're holding symposiums and roundtables. Advisory committee is being formed. Warnings have been issued to investors, and they're generally, what I see is just trying to stay on top of the topic and the technology before moving forward and issuing any rules or enforcement actions. So it's to me, a really, really interesting topic, and I believe something we're going to see a lot of in the coming year. So the next topic, completely unrelated to ICOs, I'm going to cover is the market access rule, or SEA Rule 15C3-5. I've seen this issue come up a lot this year, and I expect we'll see some enforcement actions in the coming year. For those of you that are not aware, the market access rule requires broker-dealers that have direct market access, or those that provide it to their customers, to have various risk management controls and supervisory procedures in place. This is mostly in reaction to the automated trading and alternative trading systems that have direct access to the market, and one mistake can cause a huge meltdown. So there's the expectation that firms will have parameters and thresholds in place to, especially on a pre-trade basis, to actively monitor the market access. So there is some good news from the 2017 exam findings, that firms are doing some good. The general sense from FINRA's perspective is that firms are maintaining documentation to support the thresholds, that they're conducting periodic reviews of the thresholds, and in certain situations they're seeing aggregation of certain limits that they think represents a reasonable threshold. But, of course, they see a lot of failures as well. In the exam findings, they summarized 6 topics. I'll address each one, but generally the sense is that you have parameters in place, whether it's by trader, product, desk, platform. Perhaps those thresholds are not as reasonable. They should be more tailored, and the testing of the parameters is not as effective as it should be. So going into 2018, I think you should be prepared to look at your parameters to make sure you can defend them, and especially FINRA is also looking at certain triggers. They generally said that they didn't see a lot of what they call hard stops, which is if a parameter threshold is hit, trading is stopped. Instead, they saw more soft limits where trading didn't necessarily get stopped, but an alert was sent, somebody investigated, but they would like to see, it seems like they like to see a lot more hard stops in place. So the specific areas, the first one is in pre-trade financial thresholds. FINRA says, like I said before, having unreasonably high thresholds in place is not really helpful. What is reasonable? FINRA gave us one example of what's unreasonable, which was one trader had buying power of hundreds of millions of dollars, which, yes, the threshold was in place, but not helpful, ineffective, because it was so high, it was never going to be met. Trading never would have been stopped, essentially. The second topic that they highlighted is implementing and monitoring credit or capital exposure. And what that means is that they found certain firms were not measuring capital or credit in the aggregate, that, again, it may have been spread by trader, by desk, instead of in the aggregate. And they found many instances where there were no procedures, no documentation when certain adjustments were made to the thresholds, and they said it was often done on an ad hoc basis, and that is not acceptable. This third issue is I think a pretty important one. So this topic is where FINRA believes that firms need to better tailor their erroneous trade controls. That's what we would think of as like the fat finger mistake. They gave 2 examples of problems. So the main one being that certain thresholds or parameters are being are measured at what they call away from the market, which means a limit would be hit if you're X% above or below the NBBO, which is the National Best Bid and Offer. The problem with that is that if you're entering large market orders, there's no limit order price reference. And also a lot of this trading is done in pre-market hours, where that's a really vulnerable time because the NBBO spread is really wide and prices are starting to trickle in, so they don't think of that as a really good reference point. They did actually provide 2 helpful suggestions. One is, instead of using NBBO as a reference point, firms can use the last sale as a reference point. That could be a better way of measuring the certain controls. And another option is to look at what they call the market impact check. So you can implement controls that measure the size of the order compared to, for example, the average daily volume of the security. Again, not real clarity as to what that level should be. They gave one example. One firm had the level at 500% of the average daily volume, and they said that was not considered reasonable. So that's just something to highlight. The next three areas of improvement relate to fixed income controls. FINRA is really concerned with the lack of market access rule compliance in this area. And essentially, they're saying the fixed income controls need to be better. Like I said before, they see very few hard blocks in this area. I think they'd like to see more, or an explanation as to why soft blocks are in place. An interesting point they made with regard to vendors and using their tools to monitor fixed income market access. They say, okay, you can use vendors, but you must ultimately be responsible for the parameters. You need to know the tool intimately. It's not on the vendor, it's on you. So they had found some instances where firms didn't even know what these vendors were setting as parameters. So again, you can use vendors, but you have to be in control of the parameters that are in place. And finally, they indicated, wanting better testing for these fixed income controls. What I found interesting was that they say in the exam findings that yes, there's a reason why we have these controls in place. You have to test them, and that's also why we have the CEO certification attesting to the firm's controls. So they didn't go, so far as to say CEOs are going to be held liable for, these certifications if the testing turns out to be ineffective. But I found it interesting, and I wanted to highlight it just as a point to make there. All right, so my next topic, quickly, I'm going to cover our ATSs, which I hit on in the market access section. Similar to there, FINRA is just going to focus, FINRA is going to focus on supervisory controls, and in particular, there's going to be a focus if your surveillance system, if there's an alert for potentially manipulative trading on an ATS, they're going to want to know how you responded, documentation, and so that's going to be something that's going to possibly come up in your exams. Okay, and then options. In the priorities letter, FINRA addressed three topics I just wanted to hit on regarding options I found interesting. The first is they described, which I'm sure most of you have noticed this year, that they developed a surveillance program to detect front-running and related options products. So that's if it's trading in one product and knowing about an order in another product before the market does, they have developed this surveillance pattern to try and investigate and shut that down. So this is going to remain a focus in 2018. Another focus for options is going to be looking at marking the close, where traders are putting in orders right before the close to try and have the NBBO benefit whatever position they're taking. So look again for some more investigations there. And this is the last point. It's a very technical point. Not going to go into detail, but I just wanted to highlight it, that they're going to conduct reviews of violations of Rule 14E-4, which I'm sure all of you know pertains to prohibited transactions in partial tender offers. So the takeaway there is if you are to look out for if there's any partial tender offers going on, and you have to properly account for your options positions in a certain way. And so if that area hits you, take careful look at your policies and be on the lookout for that scenario. Okay. I think now I'm going to turn it over to Kayla, who is going to read you a CLE code, right? And but importantly, please stay tuned after you get the code. Joe is going to cover some interesting topics, and you will find the answer to our trivia question.
Thanks, Allison. I will quickly read this code for those of you who are seeking CLE credit today. You can type it right into the box shown here. It's a 5-digit code. The code is DX8CI. Again, that's DX8CI. I'll just read it one more time. D as in dog, X as in xylophone, 8, C as in cat, and I as in igloo. I'll leave this open just for a few more minutes. For those of you seeking Kansas, New York, and New Jersey credit, in addition to filling out this polling question, you will need to complete the attorney affirmation form and return it immediately after the program. A copy of that form can be found on the resource list widget. You can fill that out and return it to me via email at khooven@foley.com. And as a reminder to all of those seeking CLE today, your certificates of attendance will be distributed via email approximately 8 weeks after this web conference. I'll just leave this open for one more minute here. All right, and now I'd like to turn the program over to Joe.
Well, thanks, Kayla and Dean and Allison. I'd like to add my welcome to everybody and thanks for dialing in and tuning in and logging in with us today. So let me start with best execution. We've been talking about best execution in the FINRA space for many, many, many years. There was a critical regulatory notice in 2015, which was 15-46. And if you're particularly if you're in compliance, you're very familiar with Rule 5310. And the rules I'm going to talk about are all cited and sometimes quoted in the outline. So I'd refer you over there for the finer points. But best execution is basically finding the best price available in the marketplace, taking into account all relevant factors. And what's new for this year is something that's kind of interesting. So for years, as part of a broker-dealer's obligation to do a regular and rigorous review of their best execution, there's been a requirement that they look at a number of factors, and those factors include a lot of things, but relevant to this discussion, you should have been considering the price improvement opportunities that you were offering your customers, either through internalization or through your routing practices to various market centers. You should also have been considering the impact of payment for order flow or other remuneration or even that internalization on the degree of best execution being offered to the customers. What's new this year is that FINRA, which has always looked at your process for doing that, where you're actually doing that kind of review. And I'm not going to say it doesn't matter what your results were, but if you actually could demonstrate that you were doing a regular review and it was robust and you were looking at all the relevant things, by and large you were going to be able to be okay. It looks like from the letter this year that they're going to look at it a little differently in the future. They're going to actually assess the degree of price improvement that's being offered by the firms. And one can imagine that you're going to be scored based on how much you provide that improvement to your customers. So we should look out for that. We're not sure, we haven't seen it yet, but they're working on it, and apparently it's coming. Now what we have seen as part of a sweep, which they've announced in the letter as well, that began in November 2017. They were looking at specific firms and looking specifically at the payment for order flow and rebate arrangements that they had with their with market centers. So they're reminding us both through the letter and through what they're doing out there in the sweeps, which haven't yet led to any enforcement actions that I have found. The focus needs to be on this particular item. Now, taking that sort of one step further, in the fixed income space, we've got this new development this year with the requirement that member firms report treasury transactions in the secondary market over the TRACE system. So, TRACE has been around for a while, the Trade Reporting and Compliance Engine. But in 2016, FINRA proposed a rule change to add U.S. Treasury securities. And that's the actual U.S. issued securities like, T-bills and notes, not the agencies like Freddie Mac and Freddies and Fannies and so forth that are treated differently. But that the Treasury securities be reported in the secondary market. So we knew about that last year. I think we even mentioned it on this call. But what is new for this year is that we are going to have this data now. What the Treasury Department and the Federal Reserve Bank of New York is aiming for is a comprehensive data set. Now, pause for a minute and ask yourself, how comprehensive can it be when only FINRA members are reporting? We're not yet at a place where all participants in the Treasury market are reporting. But for what it is, it's going to be a data set that's going to be available for examiners and regulators to come in and look. So if the examiners are looking, you need to be looking first. With Super Bowl coming up this week, it would be a real dereliction of a coach's duty, right, to go against another team without doing some scouting. And here they're giving you some notice. That's what this letter does every year of what they're going to be looking at. So there is a TRACE report card that's already available to you, the TRACE Quality of Markets report card, and it focuses on these main things that you should be able to tell from that report card or from your own internal data. Whether you have late reporting. The goal someday will be to have real-time reporting of treasuries, but right now it's just end of day or next day if the transaction is executed after 5 p.m. But do you have late reporting? Do you have a misreporting or failures to report? Inaccurate times, all those kind of things. But then this is what I really wanted to get to here is this comment in the letter where FINRA says that we will expand our review of execution quality and fair pricing in fixed income securities, and we expect to implement surveillance patterns that focus on fair pricing and best execution in transactions in Treasury securities. So right now, what you have in your TRACE report card is a lot of data regarding the report. The report card will tell you whether you didn't fill out the compensation field of the trade report. It'll tell you if the frequency with which you have odd compensation in a couple of different categories, unusual compensation. But it won't actually give you kind of a markup report. Now, FINRA has said that there's going to be a report card for fixed income markups. And they've said that report card for fixed income markups is going to include corporates and agencies. Doesn't say it's going to include treasuries. So this is something really to look out for, whether there's going to be some tool available where you're actually able to look at the remuneration charged on Treasury securities and be able to actually do anything with it. They're clearly going to be looking at it or figuring out a way to look at it in the coming year, and I think it's incumbent upon the industry to be thinking about ways that you can get ahead of that and develop some procedures to make sure you're looking at that, adding that basically to the same kind of regular and rigorous review that you're doing already for regular equities and other fixed income transactions. All right, cybersecurity. Another thing that's a perennial sort of all-star topic for these letters. But so I won't go into it in any great detail, other than to really point out what I think the issue is here. This is not going away. The cyber intrusions are increasing everywhere in corporate America, and financial service companies, healthcare companies, and law firms are actually among the greatest targets of cyber intrusions. And this is particularly important for financial services firms because you have customer data that can easily be used for identity theft. So this is deadly serious, not just as a regulatory issue, because Dean Allison and I are trying to keep you out of regulatory trouble, but also it's a huge business risk, right? So at some point, whether the regulators are knocking on your door about it later after the intrusion is really not the most relevant thing, right? Because the business may have suffered incredible losses before that ever happened. I do want to point out what I think are some takeaways really quickly from the examination letter and the priorities. And that's the good, the bad, and the ugly theme. The good this year, FINRA had a lot of good things to say about what firms were doing in the cybersecurity front, and you can read them on the slide. One of the things about the good that I'd like to call out for you is just to pat everybody on the back. Our industry, the broker-dealer and financial services industry, is a leader, right, in cybersecurity. Now, the takeaway from that, I guess, is that because you're such a leader, FINRA is being exposed to some very sophisticated approaches to cybersecurity. And as a result, we've set our own bar very high. So, imagine an examiner that's just gone and looked at a firm that has very, very, very robust cybersecurity. I'm always afraid that they're going to go to the next firm and seek to impose that high bar as the minimum bar, right? And it's still the requirement that you have reasonable procedures, but that level is being raised all the time, almost to a point of where best practices are becoming the minimum. That's not a FINRA expressed policy. That's just my opinion, but it is something I think we all have to look out for. And to the extent that it's possible, out there in the world of collaboration for people to use industry forums and so forth to share best practices. Now the bad, where FINRA has really pointed out things that have gone wrong in the cyber world, it's almost always been for lack of a formal process. All right, a lack of firms really get in trouble where they lack really robust written procedures. You may be doing everything right. You've heard me say this before. You may be doing everything right, but if you haven't documented it, it's as if you're not doing it at all. So the takeaway is to really document it. The ugly, I refer you to the outline for the three most recent enforcement actions that have been brought by FINRA. two of them were settled, and one of them was filed in October. The facts are really kind of interesting, but in two of those three, I will note that FINRA did not go after the firm because the firm had great procedures and because the individuals involved in the cyber theft, internal cyber theft, were misrepresenting to the firm regarding their compliance with those procedures. So, procedures. And lastly, new rules. For the first time, this is a great new tool. If you haven't been keeping track of all the dates that the new FINRA rules go into effect, this letter, and hopefully they'll repeat it in future letters, gives you a smattering of the important rules that are going to be going into effect, including as recently as next week. Now, caution though, these are not all the rules. So there are other FINRA rules that are slated to go into effect during the year that aren't called out in the letter. Most of those are minor improvements, but anytime FINRA changes a rule, you've got to go back to your procedures and make sure your procedures have tracked the most current rule. Of the new rules this year, the one that I'm most afraid of is the customer due diligence rule that FinCEN has put into place, and that relates to AML. And my fear there is just simply because if FinCEN is requiring financial services firms to do more surveillance, or excuse me, more due diligence on customers, that's more data that FINRA examiners are going to expect you to have in your files, and it's going to affect suitability determinations after the fact. It's going to affect a lot of things that go down that may impact enforcement and compliance examinations down the road. So even though it's an AML policy, you might want to think about how that impacts other areas of your firm. If you're collecting data for one purpose, you might be charged with knowledge of that data for other purposes as well. So with that, turn it back to Dean.
Oh, great. Thanks, Joe and Allison both. Really appreciate the insights. Thank you to all of you for joining us. We do have a couple of questions out there, but I think what we're going to do is, since we're a little bit over our allotted time, is just respond to those folks directly. Before I let you go, though, I will let you know the answer to our trivia question. The original name of what is now FINRA was the Securities Industry Regulatory Authority. I was actually very impressed with how many people got that answer correct. But the first person to get that correct was Paul Weick from Key Investments, my good friend. So, Paul, you will be receiving a nice bag with a whole bunch of very nice Foley and Lardner tchotchkes that hopefully you'll enjoy. There were several of you that came in literally moments after Paul answered, so apologies. I don't have a second place prize. But again, very impressed with the answers. There were a couple of you that answered in a way that made it clear that you had Googled the answer, which is okay in any event. Again, thanks to all of you for joining us. If you do have any questions or any follow-up, please feel free to reach out to me or to Joe or to Allison. We'd be happy to respond to you directly. And with that, I think we're going to sign off. Oh, one final housekeeping matter. I think there is a short survey that will pop up after the presentation ends, and we'd very much appreciate if you could fill that out and give us some help for our next webinar. Thanks so much, everyone.